Recession, a word that constantly came out these few weeks. But what does it mean? Although the definition of a recession varies between different countries and scholars, 2 consecutive quarters of decline in a country's real gross domestic product, real GDP, is commonly used as a practical definition of a recession. From the graph shown, we can see that the recent 2-quarter had negative reading of GDP growth rate. Technically, the American economy has entered a recession. However, the National Bureau of Economic Research, NBR, defines a recession as a significant decline in economic activity that is spread across the economy and that lasts more than a few months. Basically, NBR says that a recession is normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. That means if the economy entering recession, these few economic data also need to go down. So, will the economy entering a recession or the economy already in the recession? Let's look at these data before we decide what state the economy is. As we all know, the Federal Reserve announced that it's raising interest rates 0.75 percentage points following its July 26 to 27 meeting, bumping the federal funds rate to a target range of 2.25 to 2.5%. Federal Reserve Chairman Jerome Powell said interest rates are now neutral, or the level at which rates are neither stimulative nor restrictive. The comment helped fuel rallies in both stocks and bonds on the interpretation that rates don't need to go much higher. Now the market is predicting a 68% chance that the federal fund rate will be between 3 to 3.25%, so that's the stock market's next prediction. However, here is the things. There is 2 more inflation reports come out before next interest rate increase. The first inflation reports will come out on August 10th and the other one will come out on September 13th. So a lot will change at this time. The Consumer Price Index, CPI, increased 9.1% over the last 12 months to an index level of 296.311, the largest 12-month increase since the period ending November 1981. For the month, the index increased 1.4% prior to seasonal adjustment. Inflation is now running at the highest point since 1981. However, St. Louis Federal Reserve President James Bullard compared the Fed's current situation to the problems central banks faced in the 1970s and early 80s. He expressed confidence that the Fed today will not have to drag the economy into a recession the way then-Chairman Paul Volcker did in the early 1980s. Bullard also estimated the Fed funds rate most likely will have to go to 3.75% to 4% by the end of 2022. The reason Bullard thinks that economy will not enter recession is because of the strong job markets. But the job market data is a lagging indicator. So stock market will go down before the employment rate does. The U.S. unemployment rate decreased to 3.5% in July 2022, the lowest since February 2020, from 3.6% in the previous period, while analysts expected it to be unchanged. Besides, the U.S. economy added 528,000 jobs in July of 2022, much better than market forecasts of 250,000 and above an upwardly revised 398,000 in June. If the job markets continue strong, the Fed will raise interest rate more hawkish when the inflation continue go high in next few months. After we saw all these data, what do you think about recession? Do you think we will enter a recession or are we already in a recession? In my perspective, none of this matter. Recession is just a word and the definition can be changed again in future. The only thing matter is what will markets move in future. Since we are unable to time the market, the only things we can do is be prepared for the market uncertainty. To be prepared, here is 3 things we need to do. First, always prepare some cash. When the bear market comes, it is important to have cash reserves. The average duration of a bear market since 1950 is roughly 418 days, according to Anthony Saglambine, global market strategist for Ameriprise Financial. Just shift your view a little bit and look at this as an opportunity if you're a longer-term investor, Saglambine said. It's a good time to take advantage of dollar-cost averaging, which means you invest the same amount of money regularly regardless of the ups and downs in the market. But it is important that you only buy on companies that have strong balance sheets, strong cash flow, and products that consumers are using and need. Second, diversify your portfolio. Diversification is critical when preparing for a possible economic recession. You can reduce company-specific risk by opting for funds rather than individual stocks because you're less likely to feel a company going bankrupt within an exchange-traded fund of 4,000 others. Although growth stock is the favorite of the market in last 2 years, value stocks tend to outperform growth stocks when going into bear markets. Last, but certainly not least, one thing that's extremely important to avoid during recessions is panic selling when stocks fall. It's human nature to avoid volatile situations when the stock market is in free fall. You might be tempted to sell before things get any worse. Don't give in to your emotions. The goal of investing is to buy low and sell high, but panic selling is the exact opposite. If you have other opinions, let's comment below. Please help to like and subscribe.